Good morning to you, David.
It's been not a quiet summer. It's been a good summer for the Asian market. You guys say this can continue. Lay out the thesis for us here.
Yeah, I mean, we're very happy to see how things have been going so far because back in June, we explicitly told investors now is the time to actually move your money into the Asian market. And this summer is the time for the Asian market to outperform on an absolute and relative basis. So the thesis is like this, right? We actually see incremental step up of easing measures, as you mentioned, and also the anti-involution specifically. I think this really set the cornerstone for sentiment improvement for onshore investors. So two things we have noticed that's really set this cycle rally apart from the previous short-lived rallies. For example, we had a very short-lived rally in September, October last year. And if we actually rewind back to right after COVID reopening, we had a short-lived rally in early 2023. But if you look at how the market has been responding to these rallies and versus this cycle, we see two things different. Number one is the onshore long-term bond yields are really picking up this time. If you look at a 10-year bond yield, 30-year bond yield, both are picking up in the steady phases. Actually, those had never happened in the previous rally. So I think this shows that onshore investors this time, for the very first time in a long time, are seeing a more upbeat outlook for China macro. So that's very important because anti-involution, I think, really helps onshore investors believe that the pricing situation onshore, the deflation situation onshore actually is likely to improve from here. Second is that liquidity is really improving. I think a lot of investors have been saying that interest rate in China has been very, very low. So there's ample liquidity, but investors just don't want to go into the equity market. I can understand why people say that, but it's not necessarily true according to our analysis. We have this proprietary Morgan Stanley Free China Liquidity Indicator published every month, but up until June, that indicator has always been negative, showing that not enough liquidity to come into the financial market to support asset pricing.
Right.
It turned positive for the first time in 2 years in June, and then sustained at that level in July. And why is that? Because the front loading of the local government bond issuance earlier this year had finally trickled down into the corporate sector. So promoting the corporate sector to be more willing to borrow and potentially invest and then expand their business. So those two things, I think, make us believe that this time the cycle can be really different from the previous cycles.
And, just to back up to June, because you guys said back in June, buy the Asian market. Was that the trigger specifically when that specific metric went positive?
Yes, absolutely. June was the first time the free liquidity turned positive.
Right. So what are the risks to watching? Apart from that, obviously, as a leading indicator?
Yeah, I mentioned onshore bond yield, so that's extremely important to monitor to see how the onshore investor sentiment could switch back to relatively more conservative. And then, of course, I think fundamentals will need to catch up, right? We cannot just sustain a market rally purely just because sentiment is going up.
Right.
So fundamentals, we need to go back to corporate earnings. The first quarter of this year, I think when I was here last time, I told you we had a very first inline result quarter for A-share market over the last 4 years' time.
I remember that,
Yes. So now we are still collecting all the data for the second quarter results season. I'm expecting another inline result, so that would be extremely important for the sustainability of the rally if it happens. And then policy events. We have the fourth plenary coming up in October. So I think, anti-involution and social benefit reforms, those actually will reinforce the conviction that the government policy is prioritizing more towards consumption and trying to rebalance the economy. So that would be a very important signal to watch. And last but not least, I think people look at margin financing and think about the fact that current margin financing level over 2 trillion RMB, once again beating the 2015 level. So people think that could be an alarming sign. We monitor that very closely.
Or is it not?
Well, it is an important metric to monitor, but we look at the ratio rather than the absolute amount. We look at margin financing as a percentage of total free flow market cap, and also margin financing as a percentage of the daily trading turnover. So both are still very stable and below the 2020 level or the 2015 level. So I think immediate government intervention at this point is unlikely, but we should just monitor all these factors very closely.
Just to clarify, intervention to prevent any bubbles, just to
actually cool down potential bubbles.
Okay.
Yes, and because margin financing is a measure that you look at how much leverage is being taken to invest in the stock market, which government would care and worry about people becoming too speculative and potentially triggering a systematic risk.
Okay, so don't get too excited over the absolute level. Look at the ratio. Okay, the other thing I want to ask you is what now happens to the Hong Kong market, right? So we've seen southbound flows, I believe now, it makes up a substantial portion of volume. Right, so that's a big thing for Hong Kong.
Yes.
What happens now if the other side of the pond is doing
well? I think after summer, the dynamics for the Hong Kong market can start to improve again. And this was another reason why we switched the preference from Hong Kong back to Asia's in June. We were seeing all these catalysts starting to support Asia market, and at the same time, we saw a lot of uncertainties being built towards the Hong Kong market, right? So southbound has always been there as a very supporting liquidity source, and year to date, it has already surpassed $120 billion. As cumulative total inflow, and we think it's going to stay positive for the rest of the year. And southbound flow actually now represents up to 40% of the daily turnover of Hong Kong in terms of daily net inflow, and the total southbound ownership of Hong Kong market is around 15% of the free float market cap. So I think the importance of southbound in the Hong Kong market will only become more and more important from here. And Beijing is very much supporting of Hong Kong's global financial hub status, and this serves not in the best interest in Hong Kong, not only in Hong Kong's best interest, but also in Beijing's best interest as well.
Okay, so we've established that the view that the market should do well over the next at least few weeks or so. So which sectors, which factors do you think will drive alpha here?
We actually still like the technology sector. We think this is a long-term theme that we should hold on to. There could be some near-term volatility associated either the Apple supply chain or the NVIDIA supply chain, but I think the long-term localization theme is here to stay. So we have always recommended investors to hold on to large cap names that have transformed themselves into AI leaders such as Tencent and Alibaba. And we have some other niche players on the edge AI side, which we think China actually has the leading position on a global basis with the data availability and with the deep penetration of mobile technology. And aside from that, we actually still think that investors can hold on to some dividend yield plays to smooth out the volatility. And recently we had some exposure to insurance within the financial sector. We think that's a good place to be.
Why did you add to insurers? What was the thesis there?
Yes, because if you think about it, particularly the domestic insurance players, right? The interest rate environment in the onshore, and we just talked about it, is actually stabilizing and potentially picking up. So just from a revenue and margin perspective, that's actually more supportive for insurers versus for banks. And the dividend yield is still around 4%. And I think compared to the rate cut environment in general on a global basis, this is still very attractive.
Are you seeing any strong evidence of flows from fixed income, fixed deposits, to the point you're making on rising yields is a good for the equity market, into the equity market?
I think that's a big important source for the rally so far in terms of incremental liquidity. Where is the actual money coming from, right? So I think, rotation from bonds into equities and from term deposits that made a few years back at a relatively higher interest rate, those term deposits are maturing as we speak, and the current rate environment actually makes equity market a lot more attractive versus a few years ago, right? And then, of course, there will be incremental insurance money coming in to buy the equities as well, given that there has been top-down guidance from the regulators, from the governments to encourage insurance companies to allocate more money into equity asset class.
Before you go, I want to ask you about your separate note here, southbound inclusion. We've established the importance of these flows, right? And you guys launched very recently here the Morgan Stanley Southbound Eligibility Trading Strategy. Not easy to say, I have to say, but yeah, so lay out, this is a back-tested strategy. Tell us how this works and what's the hit rate?
So there are two regular inclusion cycles for southbound trading. So those are the Hong Kong stocks based on Hong Kong Exchange assessment that they become eligible for southbound trading. And every year in March and in September, there will be two batches of separate stocks being included into the southbound channel. So our backtest shows that actually these groups of stocks on average would actually deliver very decent absolute return up to 30 days prior to the inclusion date. And they also, as a group, outperform the Hang Seng Index. So this would be a very effective tactical short-term trading strategy that can help investors generate good alpha. So what we do is, the key question is, do you know who will be included in the next cycle?
Yeah,
so I think
that's a key question.
Exactly. This is the tricky part. So we developed this model based on our own understanding of the eligibility test, and also with our own further refinement based on quality factors And we forecast there's going to be 19 stocks that we think are highly likely to be included in the next cycle, which is September the 8th. So now is the time to actually get some exposure to these stocks and hold up until the inclusion date.
Which is the 8th, I believe.
8th of September.
Okay, so that's
yes,
quite short.
it's coming up. So this is very timely.
It is. And I think, we're about 10 or so days away. It's almost like buy under, not buy on a rumor, but, buy on the speculation and then sell on the actual fact. Anything else we've missed? Any risks to watch, internal or external, to this equity market?
Well, I think from here, quarter results, as I mentioned, that's extremely important. And just monitor the onshore margin financing balance, but more importantly, the ratio. And we will highlight to investors if we start to see any risk building up or any inflection points coming. And I think external factors, the Fed rate cut cycle, that's a heated debate in the market. Of course, that will also impact global risk sentiment and potentially the allocation back into China, particularly into Hong Kong. So we feel that, as we get closer to the rate cut cycle, the allocation back into China will also start to pick up, given that China's macro actually is indeed stabilizing and the earnings revision downward cycle is actually wrapping up. And the current positioning by global investors is still extremely low, even though the sentiment towards China has already warmed up. Yeah. So I think the gap there to actually close is very promising in China's case.